main topic for today is how to build a diversified portfolio that fits your risk tolerance. All right, so it's kind of like it's one of those topics that's like, well, that sounds pretty simple, right? But when you dig into it, like, this is hard. This is really hard. And the reason it's hard is because if you build a portfolio, one, every portfolio should be somewhat dynamic.
Yeah.
That evolves. Now, the hard part to that is, like, you don't want it to be overly dynamic where you're thinking about it all the time, making changes every time something little happen. But you can't be too fixed. You want to make the right adjustments when they need to be made. The hard part about building a portfolio that fits your risk tolerance, that's broadly diversified, is it has to be something that you can stick with, both in the bad times, but also the good times. So I've talked a lot about in the past, like, fear and greed. Those are the two things that drive the markets and drive people's decision making when it comes to investing. Fear, when things are getting bad, it's like, oh, I want out, I want to take less risk, blah, blah, blah. And greed, it's like, if you are invested more conservatively and things are going really well, and you're like, I'm up 6%, the market's up 12, like, I want 12, and then you start making adjustments because you're missing out on potential upside. And so building a portfolio that you can stick with in both the bad times and the good times is a lot harder than it sounds.
It is.
And so I think it's a great topic to talk through today. So John, when you think about building a portfolio, trying to align someone's portfolio with their risk tolerance, something that they can stick with, like, so what are some things that you take into consideration or that come to mind?
This is a great topic. I agree with everything you said, because I see it right now with a 16-year bull market with weird things like gold, Bitcoin, silver being part of the equation, all this stuff. I see a lot of people just being swept up into the wave of this stuff and thinking it's going to last forever and not realizing their risk tolerance. And this is the way I look at it. Can you handle... So go back to 2025, April 1st, tariffs came out, people were afraid, market sold off on fear. So there's fear selling, it created a 20% plus downturn in a really short amount of time, 3-week time frame. Now, we had the fastest recovery from that 22% downturn in market history as well. So it was a very quick downturn. But here's my point. If you're invested in the market and you can't handle that, your portfolio went down 22% and you lost sleep and you can't handle it, then you are not in the proper risk profile for yourself. So it's very easy to be aggressive when things are great, and it's can you handle the negative side to that? So you need to know what you can handle, what your stomach can handle. So I think that's the first thing. Find out what your risk tolerance is. We do a little questionnaire, 100-point type of thing, and it comes out, anywhere from 20 to 100. And that tells us a little bit about you, right?
It's a piece of the puzzle that's kind of, it asks you, like, how would you feel if your portfolio was down X in X amount of time? And
this is a great question on that thing is, what would happen if the market went down? Your portfolio went down 25% in 2 days. That's one of the questions. What would you do? And the answers are, go to cash, go more conservative, stay the course for 3 months, add more or go more aggressive or add more funds, right? Well, that tells me a lot about your stomach, what you can handle that question, right? And nobody wants to be down 25% in 2 days, first of all. But the point is, like,
it's happened. And we need to know how you would react.
We need to know how you'd react. And I think that's the first thing. So even if you're not with us or you're by yourself, whatever, know that. Number one, know what you can handle. And then if you know what you can handle, I could go on forever. You also, when you do a retirement plan, just to tie something else into it.
It kind of feels like you already are. But
I know, I'm over talking. I'm sorry. Sorry, fans. So when you do like a financial plan, even if it's through your 401k site or whatever, and it tells you need to make this amount of percent of return for the rest of your life, or this is what we expect you to make, and you're going to be great, right? Or whatever it needs to be. Know what that correlates to the risk tolerance that you're taking. I think that's important too, because if you only need to make 6%, because you've already saved enough, you're on the right path, and you're an aggressive portfolio and your stomach can't handle that aggressive, and aggressive goes down 25% and you go down with it, you have fallen off like the right path for you. You should have been less aggressive in the first place.
Right.
I mean, there's so many factors, but I think knowing what you can handle, knowing what you need to handle to achieve your goals, then doing a proper allocation to address, whether that's moderate, conservative, aggressive, whatever you're in, and then sticking to the course of that with rebalancing, making sure you look at it all the time. Because the other mistake you can make You could have a diversified portfolio, feel great about it, be whatever, moderate, aggressive, whatever. Things get out of whack. You don't change it for 5 years, and all of a sudden that moderate portfolio we had a 60-40 split is now 80-20 because bonds were bad and the stocks did great, and you don't change it.
Yeah.
And I think that's another key factor is like get that back to balance. Like you're always selling profit and you're buying things at a lower, like no matter which way that turns.
Yeah.
Right. And I think rebalancing, knowing your number and knowing what you need to have is what I would say is the most important stuff. Whew. Okay, I'll stop talking.
You made a point that I wanted to talk about was like when your portfolio does get kind of out of whack and maybe the more aggressive piece grows because when those things run, they run, right? And it's going to get out of balance. Not having the greed to say, well, let's leave it, right? Like
let's let it run.
Let it run. It's doing great. And, investing sometimes can be so short-sighted where it's like you just look at the past 6 months and you're like, well, it's been doing fine. And by the time you're comfortable, like, okay, I think the market's a little wobbly, it's too late.
Yeah.
Right? Like
a lot of times
you've experienced it. And so one of the things that I always have to tell people, I had this conversation yesterday, was like, by the time you want to act on what the market's doing, it's too late.
Yeah.
And if you want to act before, now you have to be right twice.
Yeah.
So not only do you have to be right when you're getting out, but then you have to be right getting back in. And a lot of times you don't want to get back in if you were wrong the first time. So you wait for it to come down, and sometimes it doesn't. And now you're on the sideline for 2 years.
Well, and even something as simple as rebalancing can be hard because you want everything to be data driven, right? Mm-hmm. Based on because if you rebalance too frequently, you're not giving
your allocations, run, sure.
The investments that you have the opportunity to work.
Yeah.
And if you rebalance,
not enough, then
you're exposed to maybe more risk or being too conservative and out of line with your risk tolerance. So this is, it's investing, and I've said this, I feel like I've said this every time on the podcast the last 4 times, but it's like access to investments has never been easier.
Yeah, exactly.
Managing the psychological component and the portfolio and knowing when to take action, when not to take action, keeping your portfolio aligned with your risk tolerance, I would argue maybe has never been more difficult. Mm-hmm. And so just don't oversimplify it, because it's easy in today's world with technology, access to investments, to say this is easy, and it is in some regards, but have a process. Either have an advisor that you trust that knows what they're doing, or have a rules-based approach that you're following to a T, and have a process, because if you don't, that's when you're going to get blown up.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC.